The Fed wants to double down on raising interest rates, and I've just uncovered some unexpected data about stock prices in a rising interest rate environment. We're going to get to the bottom of how stocks actually perform in a period of higher rates and figure out what the Fed's actual plans are in today's video. In an effort to cool down inflation, Jerome Powell said yesterday that, quote, restoring price stability is a non-negotiable need. It is something that we have to do. Currently, interest rates sit at 0.75%, but it's set to rise at least a few more times this year. Now, I've covered inflation and interest rates in my videos last year, but since then I've learned more about what the Fed does to tackle inflation, the effects that interest rates have on stock prices, and the overall economy. The Fed is also surprisingly okay with ignoring one factor of the economy that we're going to get into, but first we need to understand why the Fed wants to raise interest rates. Now, this is actually quite simple. With inflation coming in at 8.3% in April and US retail spending rising for the fourth straight month, the Fed is looking to tackle inflation even if it does mean ignoring the job market. There are currently more than 2 job openings for every 1 unemployed worker, but Jerome Powell isn't concerned with that quite yet, even though the Fed basically only has 2 roles. And number 1, that's to maintain price stability, and number 2, that's to maximize employment.
I guess I would say this. We have to get inflation down to 2%. We've got to restore, our definition of price stability, and we will do that. It will be challenging to do that. We have to slow growth to do that. That's the idea, is that growth has to move down. That's what has to happen for inflation to come down.
Because of everything going on in the world this year, including the Ukrainian war, the ongoing pandemic, and supply chain issues, we're seeing elevated prices everywhere, including at the pump and with airline fares, to name a few. Powell also said that, quote, you'd still have a strong labor market if unemployment were to move up a few ticks. It sounded like he wanted to prioritize price stability first and foremost, which actually takes us to part 1, the upcoming Fed meeting schedule. Earlier I said that the current interest rate sits at around 0.75%. If you'll remember, we had a 0.5% or 50 basis point hike this month in May, as well as a 0.25% raise back in March. Well, there are 5 more Fed meetings this year where they could potentially raise rates, and that will happen in June, July, September, October, and November. Jerome Powell has now said that he is targeting at a minimum 2 more hikes at 0.5%, with even more possibly depending on how the economy does. The first of these 0.5% or 50 basis point hikes should come in June. That's basically what they've been saying to us all this time. And then in July, that's the second part of the hikes. So by the end of July, we should be seeing at a minimum a 1.75% interest rate, which is a 0.5% hike in June and July. Now, why wouldn't he just do it all at once? Well, he was asked this.
Why not just do a percentage point at your next meeting, rip the Band-Aid off?
Well, as you know, inflation works through, monetary policy works through expectations. So markets are pricing in a series of rate hikes, a significant series of future rate hikes, amounting to already having done that. So we like to work through expectations, and I'm not blessing any particular day's readings, but it's been good to see financial markets reacting in advance.
The Fed loves working through expectations and talking about expectations, but we'll have more on that later. Following the meetings after July, that would mean that there are 3 more meetings, September, October, and November, and it is theorized that there could be 3 more rate hikes between 0.25 and 0.5%. That would bring the total overall interest rate to between 2.5 to 3% by the end of 2022. Powell even said that, quote, if that involves moving past broadly understood levels of neutral, we won't hesitate to do that. The Fed's definition of a neutral interest rate is the theoretical rate at which monetary policy is neither too accommodating nor too restrictive. It's a dynamic rate, so it's not actually set in stone, but the inferred rate is roughly 2.4% according to the article's reference this year. If the interest rate is at 2.5% by the end of the year, we can expect most likely a slowdown in growth, and we'll talk about how that affects stock prices shortly. But first, we need to talk about interest rates and how they're going to cool down inflation, because that is the #1 priority of the Fed right now. So part 2, cooling down inflation. I realized this back last fall in a discussion with a fellow content creator, Kyla Scanlon. The Fed doesn't have that many tools at their arsenal to combat inflation. They can put policies in place like tapering or raising interest rates to nudge the expectations of inflation, but essentially that's all they can do. They can nudge. And you'll hear Jerome say this in the following clip.
We don't have precision tools. We can't say let's dial it into this exact level. we raise interest rates, that affects financial conditions, and financial conditions affect the economy.
And this is what's funny, that inflation follows expectations. If you expect that you'll have a much harder time borrowing money because interest rates are higher, you better not spend as much money right now, which should in turn lower the overall demand for goods. Now, this is best illustrated by a small business example. So let's say you own a donut shop and you want to expand your shop. Well, if interest rates are low, you might be more willing to take a loan from like a bank to expand your business, especially if the bank is giving you a low interest rate under 3%. So let's say you have a donut shop cleverly named the Donut King, or Old Fashioned, if you will. That's a pretty funny name for a donut shop. But let's say you borrow $100,000 and you want to invest in your business. You go buy better ovens, you buy better racks for your donuts, maybe you buy a new cash register, a new refrigerator that's going to hold all the Arizona iced teas. That $100K that you borrowed and spent is going to all of these other merchants. That means increased revenue throughout the entire chain. But if you think interest rates are going to go up, maybe you don't pull the trigger right away on a loan, and you might think twice about borrowing that $100,000, and you just might wait for a better time in the market. Now think of that small donut shop, but multiply it across tens of thousands of small businesses across America. Voila, this will lower the overall demand for goods. Just because you're expecting a rate hike to happen, you're anticipating it, you're basically tailoring your behavior for that future event. And that's what the Fed wants. They want you to react this way, because if demand falls for goods, then the prices should fall too, and thus inflation should cool off. So if this is the intended path the Fed wants to take, that brings us to part 3. What does this mean for your stocks and your investments? Rising interest rates are usually bearish for growth stocks because that means it costs more to borrow money. Many years ago, I discovered something. A lot of growth stocks are unprofitable. They highly leverage debt and borrowing. As interest rates rise and the cost to borrow increases, the method in which growth stocks are valued is affected. One of the ways to value a company stock is through finding the sum of all of its expected future earnings, typically 5 to 10 years in the future, and this is called the discounted cash flow model. Future earnings are then multiplied by a discount rate to figure out what they're presently worth, and the discount rate is typically affected by interest rates. With rising interest rates, it actually hurts the present value of their future earnings and thus the stock price. For real estate investments, it's usually a bear sign as well, since it now costs a lot more to borrow the same amount with higher interest rates. You're going to see the demand for real estate go down since it becomes pricier to buy properties. Rising interest rates are usually good for banks and value stocks. Banks benefit from rising interest rates because now it means that banks can earn more from the spread between what they pay and what they can earn from, say, treasuries. Rising inflation and interest rates should also benefit value stocks because the profit from value stocks will come sooner, so investors should find value in them sooner rather than growth stocks. Now here's the fascinating bit. What does the data actually say about stocks in a rising interest rate environment? In a rate hike cycle, we actually find that the actual performance of stocks saw an increase across 5 out of the 6 past rate hike cycles, as illustrated by this table. Quote, when factored together, the S&P 500 saw a median increase across all 5 cycles of 30%, while the NASDAQ delivered a median gain of nearly 27%, and the Dow Jones delivered a median increase of 17.4%. Now, while this does sound nice and dandy, it doesn't mean that's always the case. There's just so many other factors going on in the world that we might not be able to account for. For example, inflation, unemployment, the ongoing war, supply chain issues, these all can't be ruled out. A better idea is to diversify your investments across all different asset types and hold for the long term. Lately, I've personally just been doubling down on my index fund holdings, VOO, and dollar cost averaging with a time horizon of over 20 years. I'm going to share with you guys this article, which is called How to Think and Act for the Long Term by the Irrelevant Investor, and it's a good lesson on perspective that I'm going to also link down below. My favorite part of this article is the zoom out part. You'll actually notice that the returns for the past 3 years are astronomical. Quote, this brought the 10-year annualized return to 15% a year. Clearly, this is not sustainable. You were probably expecting a pullback at some point. Well, here it is. You cannot expect a pullback and then freak out when it happens. I mean, you can, but you're not going to have much success if you do. If you think that you can sell stocks on the way up and avoid stocks on the way down, and you do that over and over and over and come out ahead after paying taxes, you're kidding yourself. This article was written no more than 2 weeks ago, and we just basically need to manage our expectations here. If you enjoyed this video, consider subscribing to my weekly newsletter, Hump Days. It's free and we cover business news and tech news on Wednesdays and Sundays. Don't forget to subscribe to this channel, and I'll see you guys in the next one. All right, peace.